You're welcome to this lecture, and we're going to be looking at Introduction to Tax Audit. Before we look at what tax audit is, what is an audit generally? Basically, an audit involves the examination of an expression of opinion on the truth and fairness of the financial statements and underlying records. Truth and fairness of financial statements and underlying record. And this is done by an auditor in pursuance of his appointment and in accordance with statutes. Now, this definition given is in line with the statutory definition of an audit. Okay. Now, types of audit. Generally, audit can be divided into three. We have statutory audit, non-statutory, and specialized audit. Statutory audits are audits that are compulsory or that are in place as a result of compulsion by statute. For instance, now, Company and Allied Matter Act, Cap C20, Law of the Federation of Nigeria 2004, makes it compulsory for all companies to be audited annually. That is, the financial statements, the underlying record, and some other things would have to be audited by a statutory auditor. The same thing goes for banks and other financial institutions acts and some other statutes that governs the operation of some specialized companies. Two, we have non-statutory statutes. Non-statutory statutes are statutes that are not in accordance or with any statute, or that are not as a result of any statute, but at the will or desire of that particular company or the management or the owner of that particular company. For instance, the audit of a non-governmental organization, non-profit or making organization, a sole proprietor, sole trading business, or a partnership business. All these organizations do not require statutory audit, but yet they are being audited. Okay. Then three, we have what is known as specialized audit. Specialized audits are not a kind of audit that occur in special circumstances. You understand? They are not the normal routine audit of companies or business organizations that take place, but they occur as a result of special circumstances. An example of a specialized audit is the tax audit. Okay, and that's where we are going. So the essence of going through this is just for us to know the interrelation between tax audit and other types of audit. Now, what is a tax audit? There are as many definitions as there are tax practitioners and writers. Tax audit has been defined as one, the review of tax returns, that is the financial statements, the schedules, the tax computations, the capital allowance claims, review of all the tax returns submitted by the taxpayer with a view to ensuring that they comply with the relevant tax laws and other statutory regulations. From the definition, the objective of a tax audit is clear. The essence is to ensure compliance with the tax laws and other statutory regulations. Another definition given is that tax audit is an examination of the financial statement and other accompanying information of a taxable person, taking into consideration the generally acceptable accounting practice and the provision of tax laws in order to determine the accuracy and completeness of taxes payable. So it still follows from the first definition, examination. The first one says review. Understand? So as you can see from the second definition as well, the objective was given in order to determine the accuracy and completeness of taxes payable. Now, what are the objectives of tax audit? There are as many objectives as possible, so let's just run through some of them. Number one, to collect maximum revenue with the maximum economy and minimum interference with legitimate trade. That's one. Number two, to detect tax evasion through deliberate falsification of accounts and misrepresentation. And lest I forget, this tax audit, the tax audit and investigation became more much more prominent since the inception of the self-assessment era. Okay, the self-assessment era, to ensure that there is compliance and to detect the case of criminal tax evasion. Okay, 4 or 3, to identify and beat tax avoidance scheme. Tax avoidance schemes are schemes that takes advantage of the loopholes in the Tax Act in order to minimize tax liability. But sometimes the tax authority carries out this tax audit exercise so that they can identify and beat the tax avoidance scheme. The tax authority is empowered to disregard such arrangement if there is no commercial content, and if the obvious reason of setting up such arrangement is mainly to avoid tax, then they are statutorily backed up to disregard such arrangement and impose tax accordingly. So that's part of the objective of tax audit. 4, checking for genuine error or acts of omission or commission. Nobody is above error of mistake. The essence is to ensure that the returns submitted are correct. So if inadvertently there has been error, omission or commission, then it can be corrected. 5, determine whether or not adequate books or record exist for the purpose of determining taxable profit or loss of the taxpayer and consequently the tax payable. There have been cases where the determination, the returns filed have been from the blues. Understand? No books of records, no records, no books, no account to support the tax return filed. So that's what tax audit is out to check. The next point is to determine whether or not tax computation submitted by taxpayers agrees with the underlying record. It follows from the first explanation I made as well. Another objective is to determine whether or not all applicable tax legislations have been complied with. Provision of avenue to educate the taxpayers on provisions of the tax laws. Basically, majority of the taxpayers, if not all, are apathetic when it comes to payment of tax, and all they see is that the tax authority are coming to X their income. So the tax audit is an avenue for the representative of the tax authority to meet with the taxpayer and educate the taxpayer on the various provisions of the tax law and the essence of and the importance of compliance with such laws. Then it provides a mechanism for feedback to the management on various provisions of the tax law and recommend possible changes. If after the audit there were some flaws found in the system or in the control, then recommendations can be made so that the taxpayer can implement those changes for his own good. And then to forestall taxable persons' failure to render tax returns or rendering incomplete returns. And lastly, to encourage voluntary compliance from the taxpayer. So those are some of the objectives of tax audit. Now let's look at the rules. Does tax audit have the backing of the Act itself? Section 43 subsection 4 of Company Income Tax Act Cap C21 Law of the Federation of Nigeria 2004 and Section 46 subsection 4 of Personal Income Tax Act Cap P8 Law of the Federation of Nigeria 2004 empowers the relevant tax authority. When we say the relevant tax authority, that is the State Internal Revenue Service as well as the Federal Inland Revenue Service, okay, to verify tax returns via tax audit and investigation. And it's worthy to know that tax audit and investigations are carried out by tax officials of the relevant tax authority with adequate experience and qualifications and exposures. Okay, now we are talking about tax audit and investigation. Is there a difference between the two, audit and investigation? Generally speaking, audit is routine in nature. Investigation is ad hoc, a kind of a one-off or occasional, you understand, and then it's prompted by a particular scenario. Okay, Alright, now let's look at the other difference. The audit monitors compliance level, that is compliance with statute, whereas investigation checks for tax evasion and avoidance. Okay, then the taxpayers are usually notified, the taxpayer and the tax consultant are usually notified on visit. Okay, the tax authority will pre-inform the tax consultant and the taxpayer before visiting the premises. But in investigation, there is always the power of search and seizure, impromptu visits. Okay, thirdly, the scope of verification depends on areas which are likely to yield additional tax. It's not all the books of accounts, all procedures, and all underlying records that will be checked. If the tax authority or the tax audit team, if they have a reason to believe that a particular source of income of the taxpayer is under assessed, then they issue additional assessment. Okay, but under investigation, the tax investigation team verifies all books, all records, all accounts that are relevant to detecting tax evasion. Then there are different selection criteria, and not just one can be used. Refund cases, withholding tax credit information, and audit projects, various bases. But for investigation purpose, selection is usually through referrals from the tax audit department, or is sometimes based on information excess or suspected cases of deliberate or willful or reckless evasion. Okay, and lastly, audit is routine in nature. Investigation is occasional, is one-off, understand, and it occurs when there is cases of when there is confirmed fraud or suspected fraud. Okay, now reasons for tax audit and investigation. The reasons and objectives should have been the same thing, but since the syllabus splits it into difference, and additional reasons have been put here. 1. To identify exaggerated refund claim, to detect underreported sales figure, to detect bloated credit claim aimed at inflating input VAT, to detect over-reported purchases leading to high input VAT, to identify false export claim. This can lead to unrealistic input VAT credit, to check accounting systems to ensure they are in conformity with acceptable standard, to minimize arithmetical accuracy, to minimize arithmetical inaccuracy, and to identify accounting error. Okay, but these are further reasons for instituting tax audit and investigation. Now let's look at the appointment of tax auditors. Who appoints tax auditors? Tax audit is, like I said earlier on, under the rules that is carried out by the staff of the relevant tax authority, and it is carried out by a group of well-trained specially support staff of the relevant tax authority. Usually they are independent of the claim business, that is, they don't have any interest in the business of the company they are going to audit or investigate. If any of the member does, then it will not be allowed to be part of the team that will audit or investigate that particular company. Now, with the decentralization of the inland revenue, each integrated tax office or the large tax office has its own resident tax audit unit. Before the decentralization, the tax audit is part of the assessment, tax audit and investigation department of the Federal Inland Revenue Service, and usually they come from the headquarters. But now that there is decentralization, each integrated tax office or large tax office has its own resident tax audit unit. Okay, now what are the duties, rights and obligations of the tax auditors? The duties and obligations are usually aligned with the objectives of tax audit and investigation. So the duties and obligations will be in line with what we have discussed. 1. To report on whether or not adequate books and record existed upon which the tax computation would have been based. Then 2, to report on whether or not tax computation submitted agrees with underlying record. Underlying record. Okay, so that there wouldn't be disparity. Then 3, to report whether or not all tax laws have been complied with. So those are the duties and obligations of the tax auditor. Now, attached to these duties and obligations are rights, because without those rights, then the duties and obligations might not be carried out successfully. Okay, 1, the right of access to information. The tax auditor or investigator has the right to access information that relates to his present assignment from the company or the taxpayer is investigating or auditing, to any personality or entity that has indirect dealing with the taxpayer is auditing, and can provide further information on the audit or the condition of the taxpayer. Then 2, right of access to books of account. He has a right to access the books of account, the underlying records, schedules, breakdowns, original book of original entry, subsidiary books, even the financial statement minutes that will reinforce his assertion after the audit. 3, right of access to the premises of the taxpayer being audited or investigated. 4, before I go to 4, the right of access to premises is only in the daytime, not in the midnight. If he comes in the midnight, then he will be counted or as a thief. Right to receive third-party confirmation. Third-party confirmation. Okay, right to receive third-party confirmation, especially when it concerns issues that seems not reliable from the taxpayer. For instance, bank balance and valuations and some other things. Okay, right to call for further returns, schedules and clarifications. All these rights are embedded in the Act, Section 43 of Citn and Section 46 of PT. Okay, now let's look at the types of tax audit that we have. Generally, there are 2 types of tax audit. We have desk audit and field audit. The desk audit is routine in nature. Now, this is common and repetitive. It means that almost, if not all, the returns filed by taxpayers go through this type of audit, and it is done in the tax office. It's done in the office of the relevant tax authority. Usually the inspector of taxes in charge will go through the returns file to ensure completeness and accuracy of computations, completeness of these returns, and then accuracy of returns filed. And if there are mistakes or incompleteness, the inspector will communicate the taxpayer or the tax consultant, as the case may be, to furnish further information or to recompute, taking cognizance of the mistake that has taken place. The other type of audit is the field audit, which is carried out outside the tax office at the premises of the taxpayer. The essence is that it affords the relevant tax authority or the tax audit team, to audit well all the books of records and accounts of the taxpayer. But usually the relevant tax authority would pre-inform the taxpayer of the intention to audit the account of the company for tax purpose. Field audit are of varying types. We have routine sector audit, routine zonal audit, and then special purpose audit. The sector audit covers companies operating within the same industry. once the sector has been taken, all the companies operating within that sector would go through that audit. The essence of routine sector audit is to ascertain and assess the overall compliance level in that sector or industry. Then we have routine zonal audit. The tax audit department is located here in Lagos at the zonal level, and thus is much more effective around the zone. But occasionally a kind of zonal tour is made to states covered by the zone. You understand? So when such states have been selected for audit purpose, irrespective of any kind of audit that has taken place, they will still have to undergo that kind of audit. Then the last one is the special purpose audit. Like the name implies, it is not routine in nature. It is called for occasionally by the management of the relevant tax authority in order to achieve a specified purpose, or when a particular circumstance seems unusual. For instance, maybe excessive refund claim by taxpayer, that can prompt the management to ask a branch to investigate, to audit the particular taxpayer. So those are the types of audit. The next thing we'll look at is the tax audit process. The first stage of the process is the selection of taxpayer to be audited, and that's determined by the audit department of the relevant tax authority, and it's a management decision. But in reaching that kind of decision, various criteria are being used in selecting taxpayer to be audited, among which may include 2 years for self-assessment filers, a self-assessment filer that has been audited, that the last audit of that particular taxpayer was more than 2 years ago. Okay, the date of last audit was more than 2 years. Then another criterion could be a taxpayer with refund claim, a taxpayer with nil income, nil tax payable, maybe as a result of loss, continuous loss, or some other reasons. A taxpayer with low adequacy ratios. These ratios are computed by the tax authority themselves. Then it could be based on routine industrial check, or it could be based on lead information, maybe from other department of the relevant tax authority, or from a whistleblower from the outside. Then where there is a tax avoidance planning scheme, tax avoidance planning scheme, or where there is an arrangement of transfer pricing with between or among related companies. Then it could be from referrals from the desk office as well. Don't forget, we said we have 2 types of audit: desk audit and field audit. So the referrals could also come from the desk office or examination. Then it could be from the directive from higher government authority, and so on and so forth. So those are the various basis of selection of taxpayers to be audited. The second stage is the preliminary review of taxpayers' file. The essence of the preliminary review is to acquaint the tax audit team with the taxpayers they are about to audit. Then they carry out a kind of analytical review of the taxpayers' performance using ratio analysis, and then they look at areas where there is high risk. We call it high risk areas in audit exercise. They look at it. Then even apart from that, they extract background information concerning the taxpayers. For instance, the name of the company, the registered address, and the business address, the date of incorporation. All those basic information: date of commencement of business, tax file numbers, the nature of business, the external auditors, the tax consultants, their addresses, the bankers, addresses of the bankers, the solicitors and secretaries, the share capital of the company, both authorized and issued, the shareholding structures, the name of the directors of the company, as well as their addresses. And then if the company has any associated company, then it must list that. If there is litigation, if the company is involved in litigation, then the taxpayer must also, the tax audit team must also extract that, and then the accounting year end of that particular taxpayer. So after extracting the background information, the analytical review, like I said earlier on, will be carried on the financial statement of the taxpayer using ratio analysis. But basic focus for tax purpose, for tax audit purpose, will be one, the report of the last audit, or investigation. Beg your pardon here, it's like my writing is okay. The report of the last audit or investigation, that will give a pointer to what the audit team should be expecting from the taxpayer. Then the financial statement of the company, basically the chairman's report, the chairman's statement, then the director's report, the auditor's report. Those are some of the reports that will be looked at, whether the auditor's report was qualified or not, and then the director's report as well as the chairman's report. The essence of looking at that is to see the level of compliance or agreement with the other statements and accounts in the financial statement. The next focus will now be on the balance sheet, and then the P&L, the balance sheet, the profit and loss account or the income statement, the cash flow statement, as well as the value added statement, the notes to the account, and then the accounting policies, and then historical 5-year historical financial summary. That will give the tax auditor a long-term trend of the performance of that company. Okay, and then after looking at the financial statements, the background information, the analytical review would also look at the tax returns filed by the taxpayer, using a kind of spreadsheet approach. The balance sheet, the P&L, can be inserted on the spreadsheet and used to estimate the tax liability and compare it with the amount that had been filed over the years. Okay, and then after going through all this process, the computation of the real ratio starts. Usually the ratios include liquidity ratios, efficiency ratios, profitability ratios, then stability or solvency ratios. All these 4 ratios are carried out before at the preliminary stage in order to determine high risk areas, and then to also identify tax evasion tendencies. Okay, so that's with preliminary review of the taxpayer's file. The next stage is the notification of the taxpayer. The tax authority will notify via a letter the taxpayer and the tax consultant of the intention to audit the company for tax purpose. The notification letter would state the period to be covered in years by the audit exercise, and then a list of records that should be made available and arranged, and the order of which those records should be arranged. as well as the date the tax audit will commence, the date of commencement of the audit, and the date it will end, and the name of the officials that will be coming to carry out the audit. Usually the audit team are expected to carry along their ID card so that it will be easy for the taxpayer to identify them for the reason of confidentiality. Okay, so that's the third stage. The fourth stage is the pre-audit meeting. Once the audit team arrives at the premises of the taxpayer, the first thing is to carry out a pre-audit meeting with the representative of the taxpayer, usually the managing director or the finance director, and also the tax consultant of the taxpayer should be present as well. Now, the essence of the meeting is to inform the taxpayer of the purpose of the audit, to confirm some of the background information that has been extracted from the tax return of the taxpayers, and then to get other relevant information, as well as for the tax audit team to familiarize themselves with the accounting procedure of the company. For instance, now the company might be using computerized accounting system, then they need to familiarize themselves with it. Another thing could be that the basis of accounting, is it cash basis or accrual basis? And usually it is the team leader of the audit team that chairs the meeting, and a member of the team puts down the minutes. At the end, each party signs and consents to the minutes of the meeting, and copies are given to representative of each parties. So that's the pre-audit meeting. Then the field audit itself takes place. So after the field audit, immediately after, there is what is known as post-audit meeting. The meeting is held in the similar way pre-audit meeting was held, but in this case the intention or the reason for the meeting is to ask for further clarification or documents from the management of the company, as well as to iron out issues that came up during the audit. You understand? Okay, the minutes of the meeting would also be signed by the parties concerned, must be documented, and then copies given to each parties. Okay, then we have the interim audit report. The interim audit report is a kind of preliminary report that the interim report is written by the team leader after the post-audit meeting. He collates the report of all team members and write the interim report, usually stating the findings of the team during the audit and areas that would likely lead to additional assessment on the particular taxpayer. The reports should be sent to the regional headquarters of the audit department within 1 week after the post-audit meeting. That's the time limit. Okay, then after that you have what is known as post-audit review by the regional headquarters audit department, by the regional or headquarters audit department. Now, after receiving the interim report, the regional or headquarters audit will review the interim report, and as soon as possible feedback is given for the purpose of reconciliation meetings. What will be discussed in the reconciliation meeting? This reconciliation meeting is always between the tax auditors and the taxpayer, as well as his tax consultant. The essence of the meeting is to resolve the issues that have been found in the course of the audit and have been reported in the interim report. At the meeting, the issues that have been agreed, that will warrant additional assessment would be settled. Additional assessment will be raised and payment will be made by the tax authority, taxpayer. But if the taxpayer disagrees with the assessment, it can object to it, and then the tax authority will, like the normal process, review the objection, and if they agree, they issue amended assessment, or otherwise they issue a notice of refusal to amend. And in that case, the taxpayer has the right to appeal to the body to the tax appeal tribunal for companies, and to the body of appeal commissioners for individuals. And further appeals lies with the Federal High Court, the Court of Appeal, and the Supreme Court, respectively. But it should be noted principally that all the meetings and all the discussions should be well documented, because this can have effect on who wins and who loses at the appeal with the appeal commissioner or at the High Court, as the case may be. So that's the reconciliation meeting. And after the reconciliation meeting, we have the final audit report. This final audit report is very, very important, because it shows the conclusion of a tax audit of a particular taxpayer, and must be prepared by the team leader as well, the way he prepared the interim audit report, and then must state all the findings and all the conclusions reached with the in the process of the audit, and then in the reconciliation meeting, and then must state the additional assessment raised or that on the taxpayer and the tax payable, separating between the undisputed and the disputed taxes. And then the tax should cover all, the report should cover all the types of taxes collectible from a company income tax, withholding tax, capital gain tax, VAT, PAYE, and so on and so forth. And after writing the report should be forwarded to the regional audit department or the headquarters audit department. Okay, and once they receive the final audit report, they will review it, issue necessary notices of additional amendment, assessment, amended assessment, or notice of refusal to amend, as the case may be. And that concludes the audit process. The next thing we are looking at is the technical procedure, and that is the process of carrying out a tax audit, or the procedures involved in tax audit. Okay, so it's invariably similar to what we have discussed. Well, let's just look at it again. Allocation of audit cases. Each audit case is allocated to a particular inspector of taxes, okay, and a particular team. Okay, usually the allocation is made based on the competence, the qualification, and the experience of the inspector involved, as well as the size of the company and other technical factors. Okay, then 2 is the pre-audit visit activities. Like I explained earlier on, the first thing to be done is to get background information about the company, to notify them, and some other things like that. 2, we have circularization letter. Circularization letter is a way of collecting evidence, third party independent confirmation about certain information concerning the taxpayer. Then the field audit process itself, the duration usually depends on the complexity and size of the company involved. Then the reconciliation process, like I have explained. So those are the technical procedures involved in tax audit. After the reconciliation, we have assessment here. Assessment, that is additional assessment that has been identified. Objection, if the taxpayer objects to it. And after the various meeting, the final report is issued. You can see that it's exactly the same as the procedure explained earlier on. So these are the processes involved in tax audit.